And welcome back to another Econ podcast with Mr. Hagan. On this Econ podcast, we're going to continue to talk about investing. Before we do, I just want to remind everybody this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so let's go back to talking about the concept of long-term timing. And what I want to do in this video is lay out what are the kind of rules for long-term timing. Now, we're not going to get into the details of this. There's 100 different ways that people could try to predict the general long-term movements of a market. We're not going to get into all those kind of details. I just want to lay out in general what their rules are. So again, just to review, here are some of the, based on Dow Jones Industrial Average, the top 30 companies in the United States over the last 115 years or so. Here are the top major secular movements. We have a secular bull market in the 20s, bear market in the 30s into the 40s, long run bull market in the following World War II into the late 60s, a major bear market in the 70s, major secular bull market in the 80s and 90s. So how could somebody use this to make money as a kind of trading strategy? So here are the rules. Okay, sorry about that. Let me pull this down. Okay, so here are some of the rules for the long-term timers. Rule number one is during a secular bull market, you're just going to act like a random walker. So remember what that means. A random walker just means that all you do is you buy the entire market, and you hold it for the long run. Okay, that's it. That's all you do. And so you're going to buy the entire market to eliminate specific stock risk. You might buy the total stock market index fund. There's a way to do that. And then you just hold it for a long run. So during the secular bull markets, let's go back to the graph. During the secular bull markets, you're just going to buy and hold. So during this time period here, you would just be buying and holding. That was it. That's all you would do. You would buy stock and you would hold it during that time period. From the end of World War II into the early 70s, you would just buy and hold. Okay? And you would just ride the market up. From 1980 to 2000, you would just buy and hold the market. You would do nothing. You wouldn't be buying and selling. You would just be, you just buy stock and you just hold it. And at the end, you would do all right. And that would be it. So that would be the rule for the long-term timers. That's the rule when you're in a secular bull market. But what about when you're in a secular bear market? When you're in a secular bear market, then these guys are going to try to time the market. So that's why this is called long-term timing. This is not day trading. Okay? You're not buying in and out of the market every day, all that kind of stuff. This is long-term timing. This is a long-term patience, taking advantage of long-term movements in the market, if that's possible. Obviously, these guys think that it is. And so here would be their rules. During the cyclical bear markets, you would want to stay out of the market. Okay, that's easier said than done, of course. But during the cyclical bear markets, these guys would want to stay out of the market, but they would want to re-enter during the counter trend cyclical bulls. Okay, so in other words, during a secular bear market, you just buy and hold, done. During a secular bear market, now you're going to try to engage in the long-term timing. Okay, let's see what that looks like back here on the graph. So here's what it would look like. During the secular bear market, you would hope to sell. Now, how in the world would you know how to do it? That'd be a whole nother debate. But you would hope to sell somewhere up here at the top. Okay, maybe the S&P for the entire the PE ratio for the entire market might just be really high, and you're convinced that the market is in a bubble, and so you're going to sell. Okay, now again, much easier said than done. But if you could sell up here, you would want to be out of the market from here, up here at the top, to buy and then buy back in down here. You would want to be out of the market during this secular bear market. Okay? Again, easier said than done. And then to push it a little farther, these guys would say that what you really want to do is you want to re-enter the market during these counter trend cyclical bulls. So in other words, you would sell here, up here at the top, you would sell, and then you would buy back into the market right here. You would buy here, ride up that counter trend cyclical bull up to here, at which point you would sell again, and then you would stay out of the market until you got this opportunity to buy when a new long run secular bull market is established. Okay, so you're out for the secular bear market. You are out of the market the vast majority of the time. However, you will attempt to take advantage of cyclical bull, counter trend cyclical bull rallies like this one right here. There were a couple of them in the 1970s. Okay, in the 1970s, right here to right here was a counter trend cyclical bull rally. Okay, and then right here to right here was a counter trend cyclical bull rally. So during most of the secular bear market of the 70s, you would want to be out of the market. Okay, but again, can you do this effectively? That would be debatable, but if you could, you would want to buy back into the market right here and sell at the end of the counter trend cyclical bull rally. Buy here and sell here. Okay, so let me just say that again. During the secular bull markets, you're just buy and hold. You're just riding it up. During the bear markets, you want to be out of the market except during the cyclical bull rallies, the short run counter trend cyclical bull rallies. Then you would want to be in the market. Okay, I just want to say one more time, much easier said than done. This would be a very hard thing to do, but that's what these guys would be attempting. So let's just finish this conversation by coming back to this chart right here. So here are our big ideas. Here's what we've done in all these videos in the stock market playlist, and that is this: Firm Foundation and Castle in the Air both try to buy individual stocks that they think are going to outperform the market in order to make money. The Firm Foundationalists use P ratios, PD multiples, and yields. The Castle in the Air people use price patterns with graphs. The random walk and long-term timers, they instead are focused on the entire market. The long-term timers, these guys are always just buy and hold. Diversify, hold for the long run, keep your costs down, done. Okay? The long-term timers will say, yeah, we agree with random walk most of the time. In these major bull markets, we agree, and we want to just be in the market, diversified, holding for the long run. However, we're going to try to get out of the market during the major secular bear markets. Okay, that's where the long-term timers will disagree with the random walkers. But still, they are both focused on buying the entire market. Okay, so those are the four theories of the stock market as I see it. There's many other ones out there, but these are some of the major theories that focus, two of them on individual stocks and two of them on the entire market. All right, this has been Mr. Hagan with another Econ podcast. Thanks for joining me, and we'll see you on the next Econ podcast.